Hey everybody, Hutch here with BankingTruths.com, and I'll bet a lot of you are wondering, Hutch, who's got the best whole life product out there for infinite banking and dividend growth now that these big 7702 regulation changes were put into effect? This changed the way that whole life guarantees were calculated, also changed the amount of death benefit needed to wrap around your cash to still have it be treated like life insurance. Or put another way, you can actually stuff a lot more cash into a lot less life insurance than before and still get the favorable tax treatment. And it also changed, it shook up the way these policies were designed. So a lot of the carriers went back to the drawing board and kind of revamped the way they put out products. There's certain templates out there with new superpowers, so to speak. The standard way of designing infinite banking policies isn't exactly the way it was before. Like, we can build off that using these new products, and what's old is new again. So the cream of the crop, the cream's really rising to the top in terms of the biggest, strongest, and oldest companies are really looking the best out there. And that's what we're going to show you in this video. Case study video with a 44-year-old, a 53-year-old, and a 37-year-old. You can use the timestamps below to go ahead and jump ahead to anyone, but I strongly suggest you just check out the 44-year-old first right now, because there's a pattern that emerges that we'll see with this 44-year-old. So take a look. So this is a male, age 44, preferred health. That's the second best rating. We're looking at $50,000 annual premiums. And you see we have two policies that are the standard smallest base policy possible, maximum term rider, maximum PUAs. And these policies over here are either 10 pays or they're life paid up at 65, where essentially that those max PUAs are baked into a more robust base policy. Now, we actually even added term riders and PUAs onto these. These are maximum efficient across the board, and that's our commitment to our clients. We're not gonna mess around. We're not gonna play any games. You come to us, we're gonna show you the best of breed across the board. Happy to shop your situation. If you have a unique underwriting situation where maybe it's okay to go outside of that, but I think you'll find you may not need to unless you have one of these obscure underwriting situations. So Penn Mutual, I know people think, hey, we're the Penn Mutual people. It's just because they're constantly crushing. And even after the new 7702 regulations, they still came out with the most robust base policy, some of the strongest dividends out there. And don't get attached to the dividend number, because all of that means something different. Like, you could say, oh, well, New York Life has a higher dividend than Penn, and it does, but it's apples to oranges. It doesn't necessarily mean anything. You're comparing one dividend to one company to one dividend for another company. They could totally credit it different. It could mean something totally different. So again, we like to do this dollars in, dollars out. Show me the money with the best possible policy. And we tested all these companies every which way. And what we found is Guardian actually has the best, call it 90-10 policy, where you have like the absolute smallest base policy, the highest term, and the most PUAs. And you can tell in the early years, they are actually outperforming. But by year 5, they've fallen behind. The mass 10 pay looks great. And notice when we look at the death benefit for the mass 10 pay, it's so much less. And that has to do with these new 7702 regulations. They actually went with a much lower guaranteed rate at 2% versus all these other ones are using a 3% guaranteed rate. In the olden days, it used to be 4. Now it's 3. Mass for their 10 pay, not their L65, went with a 2% guarantee. And by doing so, they're able to shrink wrap a lot less death benefit around it. Well, you would think that their cash value would be so much better. And it is better than, say, the Guardian 90-10, 1090, whatever you want to call it. It is better than their L65. But notice that even by life expectancy, the New York Life 10 pay actually starts to outrun it. And I know some of you are thinking, like, I don't really care. I just want more cash value while I'm alive or while I'm retired. But remember, if you're doing it the banking way and you're borrowing against your cash value, right? Because both Mass and New York Life are non-direct recognition. So if you're borrowing against it, it actually matters how much death benefit you leave behind, because if you want the tax benefits of life insurance, you don't cannibalize the whole policy and cash it out or blow the thing up right before you're going to die. You're going to get stuck with a huge tax bill. Is you leave at least a little bit of death benefit behind. And so why not have more death benefit and more cash value by retirement, even if it means you have a little bit less cash value on the way? Like, does it make that big of a difference that you're missing a little bit of cash value up front? It's not like you're going to use it all in that year. I realize some people may just want a bigger company. Totally cool with that. Fine with that. Some people may want true non-direct recognition. You probably don't need it if you really understand how these cash value line of credit programs work. You're going to get a lower rate than you would be otherwise. But if you do, totally cool with that. We can write those. But if you want to see stress tested performance, the Penn Whole Life is crushing on both the cash value and the death benefit side. Let's go ahead and look at what happens when the dividends get lower. So this is the same 44-year-old, only we reduce the dividend by 50 basis points, 0.5% across the board for all these carriers. And similar pattern, we see that Guardian's ahead early, then Penn pulls ahead of everybody. That year 5, it was the Mass 10-pay that was ahead. Now it's the New York. Very interesting when we drop that dividend. And notice how the New York 10-pay actually keeps pace with the Mass 10-pay a lot closer and still pulls ahead and laps it in both the cash value and the death benefit, and starts with a lot more death benefit. And I know people say, I don't really care about the death benefit, but then they do, right? Like if they die and you had this basically the same amount of cash value or almost just as much, why not have a lot of extra death benefit as well, especially when things are stress tested? And that reminds me, on Guardian, notice they start with the highest death benefit. But notice in the long run, their death benefit doesn't keep up with Penn's. And part of that is the PUA ratio that we always talk about. So the Penn base policy and their PUA ratios buys you a lot more paid up additions, which is very important, because with a whole life policy, the guaranteed cash value has to equal the death benefit. And when that term wears off or it gets converted, you want lots of paid up death benefit. You want that cash value to be creeping towards that death benefit. So higher death benefit on a paid up basis is very good. Another very important part for those of you that don't know how the sausage is made are PUA loads, paid up addition loads. You pay an upfront commission every time you pay a PUA. It's one and done, thankfully. There's no more mortality charges when you buy a PUA, just that upfront load. So Guardian and Penn used to be the cheapest with a 5% PUA load, but recently Guardian had to raise their PUA load to 10 since they're allowing you to do so little base and so little term. They have to get paid somehow. Penn, on the other hand, is charging 10% that first year, and then it's 6% locked, and they can't increase that in the future, and that's for the rest of the life of the policy. Mass Mutual is going to be 7.5 for their 10-pay. Their L65 and their L99 is going to be 10, similar to the Guardian, and the New York Life policy is actually 5% in all years, although they do raise the ability to increase that if they need to in the future, as much as 20%. I doubt they would, but obviously this makes a difference since we're structuring the policies to put in a strong amount of PUAs relative to base. You want that load to be as little as possible. And all things being considered, when we look from the medium years on, Penn seems to be pulling ahead from the rest, but when we look at who's second, it's the 10-pays. Whether it's the Mass or whether it's the New York Life 10-pay are beating the Guardian 90-10 or the Mass L65, which was better than their 90-10. And Penn, you can't even do a 90-10. And I don't want to spend too much time on this because hopefully it won't happen. But if dividends go down 1% for everybody from here, notice that same pattern is here. Guardian's ahead early, New York Life 10-pay, Penn cash value. Guardian death benefit early, then Penn death benefit. And when we look at the second, New York Life is second across the board. Now, the other thing I want you to notice is that even if dividends go down 1%, You're saying, well, maybe this isn't a good deal. What are your savings account going to look like? And if you put in 350,000 over 7 years, dividends go down 7 years. With Penn Mutual, you're still ahead of the game. Actually, with everybody except for the Mass Life at 65, you're ahead of the game. And notice that you're well ahead of the game. We stop after 10 years for all of these. We basically replicated a 10 pay even with the term blends. And you're still ahead of the game beating inflation. You'd have to think that inflation wouldn't be that bad if we're dropping dividends that much. But these days with manipulation, who knows? But that's the other beautiful thing about banking is we can set it up to where you get lines of credits with all of these companies, which is another reason why you want to use the big companies. Where you get access to 95% of your cash value. Because even if there is a time where there is some kind of disconnect with interest rates, you may not want to cancel the policy in case things come back to normal, and you can borrow against 95% of your cash value and keep all of the protection benefits, whether it's just death benefits. Some of these companies actually have a built-in chronic illness rider that if you're too sick or hurt to work, again, you can tap into some of that death benefit tax-free. You can keep all of that by basically keeping 5% of your cash value on deposit, growing for you on a guaranteed basis. And even at this 1% low scenario, should be pretty good. Again, even if there's some kind of temporary disconnect. So let's take a look at the older and the younger scenario. And the older, I will say, is a little bit different. So we'll look at the older first and then jump back to the younger. All right, so for our 53-year-old preferred health, things look a little bit different here. Notice there in blue, Mass HECV. That stands for High Early Cash Value. Boy, doesn't that sound good. Everybody loves the sound of that. And my practice would be so much simpler if I just picked up that hammer and all my clients looked like a nail, whether it's HECV or 90-10. It just sounds so good. But unfortunately, it's not always the best thing, which is why we didn't even show it for the younger folks, because the L65 was better and the earlier cash value you got wasn't that much more. Now, for older folks, it's a different story. The high early cash value, we blended in that 10-90, 90-10 style. It's not quite that. It's like 88-12 with Mass. You can't quite get there with the high early cash value chassis. But again, for the younger folks, you give so much up in the way of back-end performance, it just wasn't worth it. But for the older folks where they don't have as much back-end, it actually is worth it. So that's second best early. You see the Penn still pulls ahead on the cash value and the death benefit side. You can see the high early cash value doesn't even beat the Guardian in the long run, but it's got more cash value early. And again, like we've seen before, that New York Life 10 pay pulls ahead at the very end in terms of cash value over the Mass, but the Mass cash value, the 10 pay, seems to be best. So again, we're not attached to any of this stuff. If you want the older, we can do that. That's the Penn Mutual. It's the second oldest mutual company. We're happy to look at all the company ratings, earnings, surplus, all that stuff. If you want the big 800-pound gorilla, that's the Mass or the New York Life. And if you're older, maybe that is the Mass Mutual, whether it's the 10 pay or the high early cash value. Start with less death benefit, but for those of you that don't care, doesn't really matter. So let's take a look at what happens when we stress test it, the dividend a little bit. This is the current dividend. If we cut it back 0.5%, similar story to what we saw before. Mass high early cash value is winning. Well, Penn's winning, but Mass high early cash value is second. New York Life is a lot closer when you drop the dividend, even just 0.5 point. Death benefit, same story. So when we look at the young folks at 37, preferred health, that's the second best rating. All this could be better for everything we're looking at if you qualify for the best rating. Similar story. Penn seems to be winning after the mid-years. Guardian's ahead early, but not that first year. Here it's the Mass L65. The high early cash would have been even better, but it would have lagged a little bit. The Mass L65 structured as close to a 90-10 as possible as the Guardian. Kind of keeps up with it most of the time. New York Life has the stronger long-term cash value as far as the 10 pay goes. And we look at the late years, which is what really should matter. Penn's ahead. New York Life second, Mass 10 pays right behind, death benefit, same thing. Now, it's worth noting too that the New York Life policy is called the custom whole life policy, whereas Mass is a 10 pay. They have a 10 pay and a 15 pay. If you wanted a New York Life 12 pay or a 9 pay or a 5 pay, you can go down as little as a 5 pay. We can go ahead and structure that with New York Life. It's just kind of interesting because we don't really care who you want to write the business with. As long as you want to write it with us, we're happy to stress test it, shop it for you, build it, structure it as efficiently as possible. But we have these options with New York Life where they're in it to win it right now for whatever reason, and we like it. Oldest mutual company there is. New York Life, the company you keep. Who knew? Let's take a look at what happens with the dividend 5 basis points lower. Real similar story. Guardians ahead early in death benefit. Cash value most of the time. This is a dividend 0.5% low. Penn pulls ahead in terms of cash value and death benefit. New York Life second. Cash value and death benefit, especially in the later years where it counts. Not giving up much in between. What happens if we go down to a percent lower in dividends for the young folks? Same story. So at the end of the day, don't get attached to really good marketing stories, whether it's high early cash or 90-10. Don't be a nail that gets hit by a hammer. Focus on data. That's what we do. We like to shop the individual situations. We just wanted to show you a range 37, 44, 53. We don't know whether you're standard, preferred, plus, but we'll go ahead and do this analysis for you. Go ahead and hit the schedule button below to get on our calendar. Let us hear about your situation, help you design some cash flows, whatever, do the Pepsi challenge with whatever you're looking at, and we will help you get best of breed across the board. All right? We'll talk to you soon.